What is an uptrend? An uptrend, in its simplest form, is when market comes up, pulls back, comes up, pulls back again, and comes up. This is an example of an uptrend. This is market structure. When the market comes up, pulls back, breaks structure, comes up, pulls back, and breaks structure again. This is our market structure. These are our swing points. Our higher high, our higher low, these are all our swing points. And this is where liquidity is being generated. Why is that important? How does that come into play with our trading strategy? We can see that the market comes up, pulls back, comes up, and we're expecting another pullback and a push up again, right? These institutional traders, and I'm sure this was you when you were first beginning, you would see this uptrend, this pullback, and you'd see this previous one and think, oh, well, the market will continue to do the same thing. You enter here, you put your stop right under this level, and you target something up here, right? The market fails to reach your point of take profit, comes down, hits your stop loss, and then continues higher with this large, expansive move. Why is that? This is because this, in its most basic form, is ICT's power of 3. We can see our accumulation, our simple uptrend here, right? All these stop losses being generated under here, under these points. We can see our manipulation below these points, taking out these traders before this large distributive move. How can we include this concept in the back of our minds into a trading strategy? Well, what I like to look for is I'll look for this accumulation, right? These swing points being generated here. I'll wait for this manipulation, these stops to be hit, these traders to be taken out, and I will wait for an internal market structure shift before entering to catch this distributive move. And why do I wait for market structure to shift? Why don't I go with a much more common, reoccurring, simple method of entry, like an inverse fair value gap, for example? If you're unfamiliar with lower time frames, then you might not know this, but there are hundreds of supposed fair value gaps all over this range, all over this chart. These lower time frame fair value gaps hold no significance. There is so many of them that you don't know which one to pick, which one has the proper strength, which one is a true signal, right? Because you could enter off this fair value gap, it could come back, turn you into that exit liquidity, free up your order on the order book so institutions can properly enter their large positions, high volumes, and make the real move. That is what liquidity hunting is, right? It's when the market manipulates and it frees up orders on the order book, because that's how institutions enter their large positions. If you are buying something in a large amount, there needs to be someone selling something in a large amount, right? So how can we use this to our advantage? This happens every day. This happens multiple times a day. And I will show you how to profit from this consistently, right? You see your market structure shift, you see your valid liquidity swing get swept, and then you enter. What is a valid liquidity swing opposed to an invalid liquidity swing? Well, a valid liquidity swing would look something like this, where the market comes up, pulls back, and breaks higher, right? It doesn't have to be a break of structure. It could just be a wick above, but that generates as valid liquidity because the market moved higher. But if we have something like this, where the market pulls back and even creates equal highs, or in this example, a lower high, and then sweeps down to this point here, this is invalid because no liquidity is being generated because market is not moving higher. There's no traders trying to cling on to this higher move with their stop losses below this level, right? That's why it's important to wait for liquidity to be validated. This is a valid liquidity swing. This is a valid sweep of the liquidity, and this is a valid signal to enter. Okay? And one of the most important things about this strategy, in my opinion, is the risk management. Where do we put our stop loss? Where do we put our take profit? What I like to do is after this market structure shift, I'll enter on a 1-to-1 risk to reward. And I know you might be thinking, a lot of traders have heard this their entire career. If you trade a 1-to-1, you will not be profitable. If you trade a 1-to-1, it just won't work. For every 1% that you risk, you are making 1%. And to some people who like to target these huge risks to reward, these 1-to-5s, these 1-to-6, this 1-to-10, that might not sound too appealing, right? But the power within this is the consistency that it generates, right? Say, for example, this can also act as a safety net. Say the market pulls up, uses this as some apparent liquidity, and decides to trend lower. Why would that happen? Because sometimes things just don't work out in the favor of the trader. But with this short risk to reward profile, you can clearly target that 1-to-1, maybe that lower high, and then you can take your profits securely before the market decides to do whatever else it wants to do. If you have a long-term, trend following trading strategy, and you truly believe that you could hit that 1-to-6 or that 1-to-4 or that 1-to-10, good for you. If it happens, good for you. But what I like to do is stay consistent and stay as risk-free as possible, because that's all this is, right? It's managing your risk, staying within that risk profile, and securely taking profits, right? You could win 5 trades and lose 1 with a 1-to-1 and be up 5%, and then lose 1, be up to 4%, or you could lose 5 trades on a 1-to-2 and win 1 and still be in the negative, right? It's the consistency of this that works. Okay, so I will show you guys this on a lower time frame. I'll show you, here's a very small example of what I was just talking about, how sometimes you might be wrong, but you can still profit from that with this strategy, right? So here we can see the market was accumulating. This was a trade I took in real time. You can see right here, I trade from 8:30 and beyond, right, to New York lunch, 12 p.m. Eastern Standard Time. I'll see the 8:30 a.m. open right here. I'll see the market accumulate. Right down here, I will see this little validation of this swing point, right? That swing point is valid because of this move higher, and then because traders are now thinking this is on an uptrend. These are where the early buyers come in, and they put their stop losses here. Okay, this point gets taken, and then we can see generation and an internal market structure shift. Beautiful, right? Now, I was thinking that, maybe the market could move higher and higher, whatever. I'm not sure what trend could do here, but I entered right here. I put my stop loss at the swing. I factored in the average true range value of this movement here, this candle, to give me that security I needed for my my stop loss to assure that I couldn't get swept out in a volatility move or a momentum push. And what did I do? I targeted that 1-to-1. Right? As you can see, price continued to accumulate. We hit our 1-to-1, and then the market decided to dump. It completely went the opposite direction. But it didn't affect us because we took our 1% right here. We won that trade. Okay? And this happens constantly. This happens all the time. But the important thing to remember about this is that you need to trade within session. You need to be trading these concepts during New York time, or else it will not work most likely, because after hours, who knows what happens, right? Low momentum, low volatility, low volume, things don't work in our favor. So for this example here, we could see the market pull up, pull back, break structure here, validating this swing point, the market continue up, pull back, and break that structure here, pushing even higher, giving us these valid liquidity points right down here, right? These are both valid points of liquidity in our market structure. So we can see price validates these points, liquidity generates under these points, we accumulate, we can see price manipulate down past these levels, stop out these traders, and this is another good example of why not to enter on a fair value gap. You could see like possibly a fair value gap right here, and you see this large push up, and you think, okay, this is where the distribution is beginning. I'll enter here with my stop loss right here. Stopped out right here, right? That's why you wait for the extra layer of confirmation, that of which being the internal market structure shift, right? So we can see market structure shift from this point. We can enter, right? Stop loss here. ATR value pushes it down. We go for our 1-to-1. Profits secured, right? If we decided to put our stop loss here and maybe target, a 1-to-2, for example, we would see that price seeks out our stop loss. It seeks and it destroys, right? That is what we try and avoid. That is why we scalp these small 1-to-1s. It's that safe, consistent movement. Okay? And on Euro USD, you can see that this happens a lot, right? So if we look within our session, here's 8:30 to lunch, right? We can see that it happened once here, came down below this valid swing point, market structure shift, 1-to-1 up here, twice, validated this point here, came down, manipulated, swept, and distributed again. 3 times in the span of 4 hours. That's how consistent this can be if you properly know how to trade it. This requires patience. This requires key observation. But it can be done, and very simply as well too. So I hope you learned something from this, and if there's any questions, please feel free to reach out.